one thing that stuck with me from the time that I met you before was the way you value a business. Has that changed over time? Has it changed in recent times? Maybe you can shed some light on the way you go about valuing these businesses.
Yeah. So there's a few key facets of our approach. Look, the first thing is that we calculate an absolute value, and that means that it doesn't move up and down. What we think Accenture's worth, or a Cintas is worth, or a Graco's worth, doesn't move up and down as interest rates move up and down. It doesn't move up and down as equity market aggregates move up and down. Just because interest rates are abnormally low at the moment, and even if they were to continue to stay abnormally low, it doesn't, in our view, make a business worth any more. Now, that's quite different from views that other people will take. We don't do DCFs or discounted dividends from the future, because we know that humans are biased optimistically. We can talk a little bit more about behavioural biases, but one thing we all know is that we're optimistically biased. It generally makes life a better experience. But we recognise that we're human too, and if we calculate the cash flows for a business into perpetuity, then we're more likely to be too high than too low. So instead of doing that, we apply a multiple to trailing or last 12 months cash flow. So it's conceptually consistent with discounting future cash flows, but it tries to minimise the optimism bias that gets hardwired into the process if you're valuing future cash flows. I have heard it said that a DCF model is a bit like the Hubble telescope. If you move it an inch, you're in a different galaxy. So it's hypersensitive to the inputs like the discount rate. Now, so we've got our cash earnings. We're going to value trailing cash earnings. So the question then is, well, what multiple do we put on? And there's two key variables. The first is how fast do you think the business is going to grow? And the second is the risk premium. Now, I think philosophically, and this is an important area where I think we're quite different from most, is a lot of investors put a lot of emphasis on the G. If someone uses the expression a PEG ratio, or price to growth ratio, or then it tells you that they think the only variable that matters is growth. Well, we think what matters most is risk, or the quality of the business and the balance sheet. So we're going to focus a lot on the risk premium. And we might say that let's take Accenture we think it's a much lower risk business than an average business. It's a lower risk capital structure than most. In fact, it has not a dollar of debt on the balance sheet. And we'd say, well, management, let's have a think about management. Well, for their role as stewards of the business and stewards of capital, we think they're a better than average management team. So for those three reasons, we're going to say it's a higher quality business and a lower risk business. So our risk premium is going to be lower. And if we invert that, it means that the multiple we apply is going to be higher. So we can value a business at a substantial premium to the average without even referencing growth, because we're thinking about risk premium. And I think a lot of people don't think about risk premium at all. They think only about growth. So if we, to the extent that we value our businesses at premiums, most of that premium comes from the quality or risk characteristics of the businesses we own, and a little is going to come from the growth. And we try and be very conservative on the growth. We don't assume things are better prospectively than they have been historically. It's easy to or if very fast-growing businesses are going to continue to grow at very fast rates, because then you can run into trouble and assume that 20% growth is normal and value a business accordingly, only to find out that maturation and fade of the business kick in and you're left disappointed.
This stuck with me from the time that we met, because it seems like you have a very deliberate approach to eliminating these behavioural biases that we come across. Recency bias being one, for example, the FANG stocks. People have become used to these double digits, sometimes high double digits growth rates. So just so I can confirm and summarise or paraphrase what you've just said to us, is that you value it based on trailing owner earnings, effectively, or cash earnings, trailing cash earnings, and then you apply a multiple of that into the future. Instead of forecasting multiple years, you've effectively said this is what we think based on the quality, and then it's conceptually, like you said, the same. You get the same result. You have this net present value of cash flow, if you like. Do I have that right?
Yeah, that's it. And but I think that we're going to be less subject to the optimism bias or the hypersensitivity of a DCF model to the discount rate if we alternatively take the approach of putting a multiple on trailing cash earnings. So you've got the essence of it absolutely right.
I think that's a very important concept, because for people that don't know valuation, they don't necessarily understand how sensitive it is. Like you said, the Hubble telescope example. Most people think of valuation as it's a hard science and this is the answer. And unfortunately, the science that we've been given is very hard to put in practice, because one subjective input can just fire off into the distance a valuation that makes no sense whatsoever. So, I mean, I'm sure our listeners would be keen to follow along. And if you do produce anything like this on this topic, I'm sure I would love to share it with them. Anyway, I should move on, because this is a very deep and we could go further into this rabbit hole and pop out who knows where.
Well, I think just on that, Owen, I think you make a great point that it's a business of, I think investing is a business of judgments and informed judgments, drawing on experience and an understanding of how businesses operate and an understanding of behavioural biases. It's not about quantitative metrics. I don't think that you can robo-invest and you can do all the filtering, but that's the start of the process, not the end of the process. All the filtering is going to tell you is what has happened. Our judgment is about what we think can continue to happen. And also the filtering process is going to spit out drawn accounting numbers, which of course are imperfect. And they're also going to miss, well, as we touched on earlier, is this a business with a durable moat that's getting wider or one that's getting smaller? And again, an example I thought maybe I'd touch on is, in my experience living in the UK during the GFC, one of the interesting permanent changes in consumer behaviour was the German retailers Aldi and Lidl started making an entrance into the UK market a few years before the GFC. But during the GFC, people became a lot more frugal. They'd lost their jobs, so worried about their income. And so they moved away from the Tesco's and Sainsbury's and Waitroses to the new entrants who were more of a price sensitive. But interestingly, as they got their jobs back, as their incomes returned, their behaviour didn't change, and there was a permanent change in the competitive structure of that market, and such that the Sainsbury's and Tesco's are operating in more competitive markets now, even as the economies return to health than they were before the GFC. So that's a good example of that, shrinking moat, changes in consumer behaviour that. Looking at historical numbers won't give you the full picture.
And again, it comes back to that valuation piece too, where you say it's very easy just to go, whatever happened before the GFC, that we can assume that that's going to happen into the future, which may not be the case.